The most powerful political weapon in the world isn't an army, it isn't a nuclear arsenal, it isn't even a vote. It's a spreadsheet, not dramatic, not televised, not emotional, just rows of numbers that quietly decide which countries grow and which ones kneel. We like to imagine that history turns on speeches, on revolutions, on bold leaders standing at podiums. But behind nearly every geopolitical shift of the last 50 years, there was something far less cinematic. A loan agreement, a bond market panic, a currency peg breaking at the wrong time. Power today runs through financial plumbing, and most of us never see the pipes. Right now, the world feels unstable. Inflation spikes, trade tensions rise, sanctions spread, elections feel existential, every headline sounds urgent. But underneath the noise, something calmer is operating. Predictable, structured, almost mechanical. Finance doesn't react to politics nearly as much as politics reacts to finance. Start with the simplest piece, debt. Countries borrow, all of them, even the powerful ones. Governments issue bonds to fund budgets, wars, infrastructure, stimulus packages. Investors buy those bonds expecting steady returns. That sounds ordinary. It isn't. Because once a country relies on constant borrowing, it becomes sensitive, not to voters first, to markets. If investors demand higher interest rates, borrowing becomes expensive. When borrowing becomes expensive, budgets tighten. When budgets tighten, political promises shrink. 1 percentage point added to borrowing costs on $1 trillion of debt isn't abstract. It's billions in extra payments. Every year, that changes decisions. Healthcare spending, defense budgets, energy policy, tax reforms. Suddenly they are not ideological debates, they are math problems. Now widen the lens. Who buys this debt? Pension funds, banks, sovereign wealth funds, insurance giants, foreign governments, trillions of dollars searching for yield. Capital flows aren't patriotic. They are opportunistic. If investors believe a country is stable, disciplined, predictable, money flows in. If confidence cracks, money flows out. And when it flows out, currencies weaken, imports become expensive, inflation rises, and governments scramble. This is how markets vote. Quietly, daily, without ballots. Then there's currency. The global system runs largely on one dominant currency. That dominance isn't just symbolic. It shapes trade, sanctions, and alliances. When international trade is priced in one currency, access to that currency becomes power. Countries that depend on it must maintain reserves. Banks that clear payments in it become gatekeepers. Financial infrastructure becomes geopolitical leverage. Sanctions don't require soldiers. They require control over financial rails, freeze assets, restrict access to payment systems, limit dollar clearing. Entire economies feel it within weeks. No invasion necessary. And yet the public debate usually focuses on speeches and summits. Now consider interest rates set by major central banks. When a large economy raises rates, capital often flows toward it. Higher returns attract global money. Emerging markets can suddenly experience capital flight, currency pressure, and funding crises. Not because of domestic chaos, but because money chased yield elsewhere. One policy decision in one capital city can destabilize several smaller economies thousands of miles away. That isn't conspiracy, it's incentive structure. Money seeks safety and return. Always. And here's the uncomfortable part. The system isn't broken. It's functioning as designed. Debt creates discipline. Markets enforce confidence. Currencies concentrate power. Financial infrastructure creates leverage. Each component seems reasonable in isolation. Together they form a hierarchy. Now contrast that with the public narrative. We're told elections change everything. That leaders shape destiny. That political will can override constraint. Sometimes it can. But often leaders inherit balance sheets before they inherit authority. A newly elected government might promise sweeping reform. Investors ask one question: how will you pay for it? If the answer sounds risky, borrowing costs rise, currency falls, pressure builds, ambition narrows, democracy meets bond markets, and bond markets rarely blink. There's a quiet irony here. Politicians argue loudly about sovereignty, yet many of their most important decisions are reactions to ratings agencies, to currency traders, to capital flows moving at digital speed. Public power is visible. Financial power is structural. Structural power lasts longer. Zoom out further. Over decades, countries that control financial infrastructure accumulate influence. Clearing systems, reserve currencies, global banks, development lending.
Institutions. Influence compounds like interest. Meanwhile, nations heavily dependent on external financing operate under softer constraints. Not colonies, not puppets, but participants in a game with rules already written. None of this requires secret meetings in dark rooms. It requires contracts, incentives, Risk models, spreadsheets. It is boring, which makes it effective. Now consider long-term implications. Global debt levels are higher than at any point in modern history, public and private combined. Interest costs are rising. Demographics in many advanced economies are aging. Growth is uneven. If borrowing becomes more expensive across the board, fiscal space shrinks. Governments may prioritize stability over ambition, defense over welfare, inflation control over growth. Financial constraint shapes political ideology more than ideology shapes financial constraint. And when stress builds during crises, the hierarchy becomes obvious. In moments of panic, central banks act first. Liquidity facilities open, swap lines activate, bond buying programs expand. Financial stability becomes priority number one. Because if the plumbing fails, everything above it collapses. Politics depends on finance the way a house depends on its foundation. You don't see it until it cracks. So here's the real tension. As technology accelerates and geopolitical rivalry intensifies, more countries want autonomy, independent systems, alternative currencies, parallel payment networks. But building financial infrastructure is slow. Trust takes decades. Dominance compounds quietly. Meanwhile, debt keeps growing. Incentives remain unchanged. Capital still chases return. The rules are not emotional, they are mathematical. And mathematics does not negotiate. So the next time headlines frame global politics as a clash of personalities or ideologies, pause. Ask what the bond market is doing. Ask where capital is flowing. Ask who controls the financial rails. Because beneath every speech about sovereignty, beneath every dramatic summit, there is usually a refinancing schedule ticking in the background. The world may look chaotic, but the hidden rules of finance are steady. And the unsettling question isn't whether politics shapes money. It's whether money has been shaping politics all along, so gradually, so structurally, that we mistook constraint for choice.